Good afternoon, everyone. Welcome to the HKU-SCF Fintech Talk Series. I'm Edith from the Academy, and I'll be the MC for today's event. For those of you who have been to our Fintech Talks or research seminars before, welcome back. Happy to see you again. For those of you who are new, allow me to quickly introduce the Academy and our Research Assistant Professor Scheme. The HKU-SCF Fintech Academy was established in April 2020 through a commitment of 60 million Hong Kong dollar from the Standard Chartered Hong Kong 150th Anniversary Community Foundation. We're hosted by the Department of Computer Science of Faculty of Engineering with support from Faculty of Law as well as Faculty of Business and Economics of the HKU. Last year, the Academy launched a Research Assistant Professor Scheme. Currently, 3 research assistant professors with PhD from the field of computer science and law are recruited to conduct interdisciplinary research on fintech, as well as to host fintech talks regularly to share the latest fintech technology and trends. So today, we're very excited to have one of our research assistant professors, Dr. Evan Gibson, to give a talk for us. Dr. Evan Gibson is a research assistant professor funded by the HKU-SCF Fintech Academy, hosted by the Faculty of Law at HKU. Dr. Gibson's research and teaching specializes in financial regulation, banking law, financial technology, regulatory technology, economics law, comparative law. Prior to joining HKU, Dr. Gibson held research positions at UNSW and the Asian Institute of International Financial Law, where he was involved in fintech-related research. So without further ado, let me invite Dr. Gibson to give a sharing on the topic, blockchain, a financial regulatory cryptogram.
Hello everyone, my name's Dr. Evan Gibson, and tonight I'll be talking on blockchain, I should say, not Bitcoin, blockchain, a financial regulatory cryptogram. So what do I mean by a financial regulatory cryptogram? What is a cryptogram? A cryptogram, more generally, is a puzzle involving code. But when we think about a cryptogram in terms of computer science, information technology, or blockchain, we're talking about text that's transformed into code, or essentially cryptography. So a financial regulatory cryptogram is the challenge of regulating blockchain technology, which is designed around cryptography in the financial services sector. To explain this, to elucidate this further this evening, the structure of my talk will be as follows. I'll begin with some common applications of blockchain technology, and in particular, I'll be focusing on the application of blockchain technology as financial market infrastructure. So financial market infrastructure is essentially infrastructure that is implemented by governments, finance ministries, or financial market regulators to ensure the efficient functioning of markets. From there, I'll then look at some preliminary design considerations if financial regulators are considering adopting this technology. Then I'll delve a bit more deeply down into the design considerations to explain what exactly is blockchain and to also look more closely at cryptography. Then I'll explain the 4 different types of blockchains before turning back to answer the question, what is a financial regulatory cryptogram? From there, I'll explain where my research, what my research will be focusing on moving forward, and then to conclude, I'll answer some of your questions. So, everyone's heard of blockchain predominantly because it's been associated with cryptocurrencies such as Bitcoin, Ethereum, etc. It's been promoted as a financial system revolution in these fields. I'm not particularly interested in these claims, marketing hype, or sales pitches. My research will be taking a realist approach. Realist insofar as the fact that blockchain has been adopted as financial market infrastructure, or its adoption is imminent in several areas. For example, trade finance. Trade finance, we see blockchain has been adopted here in Hong Kong with eTrade Connect. A similar scheme operates in Singapore, in the EU, and even India. And so we see that blockchain technology has been adopted in this area because of the extensive amount of paperwork which takes an awful amount of time and effort to fill out and is quite fragmented across logistics service providers, finance companies such as banks, and importers and exporters. So in this user case scenario, we see that blockchain is used as essentially as a database, digitizing the documentation process, automating the trade finance process. It also provides a means to trace the flow of paperwork as well as international trade. Another area where blockchain is used is in payment systems, and so this particularly relates back to cryptocurrencies. My research doesn't focus so much on the private sector, but it will look to the stat sector insofar as it applies to government-based cryptocurrencies, or in other words, central bank digital currencies. And so we see around the world at least a dozen or more jurisdictions have adopted central bank digital currencies, but not all of those jurisdictions use blockchain technology to facilitate payment system, particularly when we're looking at retail or domestic applications of central bank digital currencies. Another area is settlement and clearing systems, and in particular in relation to settlement and clearing systems involving stock exchanges. Now, this is an area where the implementation has been relatively slow for a variety of reasons. An example is the SIX blockchain system in Switzerland, as well as the ASX chess replacement in Australia. And in particular, if we look at Australia, the ASX chess replacement was first began in 2016. It was scheduled to be implemented last year, got moved back to this year, and then it's been moved back again till next year. So why has it taken so long, and what have been the main problems? Well, with the advent of COVID-19, there was suddenly an extremely sharp increase in daily trading volumes, and this caused quite considerable concern not only financial market participants, but also to the ASX itself, whether it'd be capable of handling so many transactions. There's also been some regulatory changes as well since then, and there's also been problems just with financial market participants being ready from a technological standpoint to actually use the technology. So this has slowed down the implementation. Now, these are just three applications of blockchain technology as financial market infrastructure. By no means are these the only application, but these are the three most predominant applications. There are other applications, say, for central clearing counterparties for OTC derivatives, as by way of example. So let's think about this in terms of you're a financial market regulator and you are intending on adopting blockchain as financial market infrastructure. So what are the preliminary design considerations? First of all, blockchains are not generic. Everyone thinks of blockchains in relation, say, to Bitcoin, or a lot of people do at least, or Ethereum. That is just one type of blockchain. That's a decentralized, permissionless blockchain. There are 4 different types, which I'll talk about a bit later this evening. There's also the technological design of blockchains, particularly in relation to cryptography. You can have the same type of blockchain, but the way it functions can be markedly different depending on the design. So if you're considering adopting blockchain technology, you have to address a fundamental question. Why exactly are you using blockchain? And then to answer that question, you have to look at some of the factors which will influence the design. For example, what financial market are you going to be using it in? Financial markets differ quite substantially if it's payments, if it's settlement and clearing, security sector, in insurance sector, derivatives, etc. And then you also have to be aware that the financial systems in each jurisdictions are quite different, and the way they are regulated is quite different. From that, you also have to take into consideration how will the technology affect financial market behaviour, the behaviour of financial market participants. Will it mitigate illicit behaviour, or will it actually produce loopholes or provide sort of technological advantages where it might actually promote illicit behaviour? So from these 2 points, from financial markets and the behaviour of financial market participants, we then turn to how exactly will we go about regulating financial market infrastructure that's developed around a blockchain technology. What are the legal and regulatory objectives that we seek to fulfill in relation to compliance? Are we looking at things like market conduct regulation, anti-money laundering, counter-financing of terrorism, consumer protection, financial stability, or monetary stability and policy if we're talking about central bank digital currencies? From that, the natural progression then is to look at the pre-existing financial regulatory frameworks. What are their parameters? What are their limitations? Are they fit for the purpose for regulating blockchain financial market infrastructure? So then you have to understand what exactly is blockchain. So blockchain is a type of distributed ledger technology, and so what is a distributed ledger technology, or DLT? It's a distributed networks of computers or a computer system for certain permissionless blockchains. This distributed network records, disseminates, and validates data across a network or system. So if we're talking about blockchain, it's a type of DLT that's designed around a chain structure, a shared database arranged in a chain structure. So DLTs don't have to be in a chain structure, and blockchain also consists of blocks that are chained in date order or a chronological sequence. Again, a DLT doesn't necessarily have to consist of blocks in a chain structure. So in the blockchain, each block represents a ledger, a digital ledger, and you can think of this as a digital account of transaction data. So, what is a blockchain? Data is stored across the chain of computers in the network. The computers are essentially nodes. Together, these computers or nodes form a digital database. In terms of financial market infrastructure, it's a digital database infrastructure. Now, this is in its most primitive form. The infrastructure or a blockchain can actually incorporate other technologies. It can be automated, it can have other functions, but in its most primitive form, you can think of it as a digital database. And that database continuously distributes, validates, and stores data. Particularly in relation to distributing and validating, this ensures that the blockchain is accurate and up to date. But then this leads to the obvious question: how do you ensure that the data held on that blockchain is accurate? And this is where we use cryptography. So what is cryptography? It's essentially security protocols that are used to protect the data, to ensure that that data is not compromised. So data can be compromised in one of two ways, essentially. It can be hacked from outside third parties, or you can have computers or nodes within the system that are corrupt. All transactions and all blocks in the chain across the network are connected, and they're protected by cryptography. So there are several different types of cryptography. I'm just going to discuss this evening a few of the predominant types of cryptography, but by no means are these the only type. There are several different types. So you have key cryptography, which involves the use of digital signatures. All blockchains use a hash function, and all blockchains use a consensus mechanism. So let's look at key cryptography. Essentially, you can have symmetric keys, which is one key, or asymmetric keys, which are two keys. So for symmetric key cryptography, you have one algorithmic key, and that's used for both encrypting and decrypting. The advantage is that it's relatively fast. The problem is, though, that if you want to send a transaction, a message to someone, it requires sharing the key. So you send a message, you encrypt it, you have to then also send the key with that message so the recipient can decrypt it. And this presents or this produces a major security risk because that key can be intercepted by malicious third parties or corrupt nodes. For this reason, most blockchains use asymmetric key cryptography or two algorithmic keys, a private and public key pair. The keys are managed by the blockchain software. The blockchain software also generates a digital wallet to store your keys. So let's have a look at the public key. Public key is public, exactly that. Anyone can view it, anyone can use it. The public key represents the owner of a key pair, and the public key is used to send transactions to the key pair owner. So when we use the term transactions, we mean actually transactions. You can send funds, or in terms of blockchain, transactions can be any message or data you wish to send. So the public key is used by the key pair owner to receive transactions, and so we can think about a public key as being similar to an email address or a bank account number, because a transaction can involve sending funds. The private key, on the other hand, now this is critical for the security feature of the cryptography, because it provides control over the public key, and the private key is used to both encrypt and decrypt transactions sent from the public key. So if we think about this, that if you receive a transaction through the public key, you can use the private key to decrypt it. If you want to send someone a transaction through their public key, you also use your own private key to encrypt that transaction. So when you go about encrypting the transaction, it generates a digital signature that's used to sign the transaction and send it from the public key. So we can think of the private key as being similar to a password and a signature. Password for decrypting, a signature for sending the transaction. So what are digital signatures? They identify a key pair holder for both a transaction sender and recipient. So for a transaction, it verifies key ownership, the authenticity of the data sent, and that a transaction is legitimate. Now, this is extremely important to ensure that there's trust in the system. Trust underpins most financial markets, or all financial markets, and it's important so that financial market participants have the confidence to use the technology. Digital signatures differ though from physical signatures because one signature corresponds to one transaction, although it's still used to identify the sender. So we can think of digital signatures as being a trusted identity system. It proves that a person owns a private key without having to reveal the private key. Again, this is essential for security because you don't risk having to send the private key or reveal the private key across the internet to the recipient. You obviously don't want to reveal the private key because then people can encrypt transactions sent to you and they can access, say, cryptocurrencies if they're being used on the blockchain. So if we think about this, a digital signature consists of two parts. The signing, so you use the private key to generate the digital signature, and also verifying. So we can think of verification as in terms of your identity. It's similar to if you sign a check and you hand that check to the bank. The bank then will examine the check and examine your signature. So verifying, you're using the public key to verify that digital signature has been generated from a private key. So how do you actually verify that? Well, you match what's known as hashes. They're produced by the key pair. They should match for a given transaction. If they don't, the signature won't be verified and the transaction will be rejected. So the transaction is void. If funds have been sent, the algorithm performs restitution. So the funds will be returned to the sender and the transaction is not recorded on the blockchain. However, if the digital signature, if the hashes match, the digital signature is verified and the transaction is provisional but unconfirmed. It's unvalidated. So how do we validate the transaction? We use a consensus mechanism. But before we look at the consensus mechanism, I just want to discuss hashes, the hash function. So all transactions are hashed by a one-way cryptographic algorithm. So hashing differs from cryptographic keys. It doesn't involve encryption or decryption. It's just a one-way algorithm. So what it does, it takes the transaction, any transaction, and it converts it to a fixed length output. This is known as hashing. So a consistent fixed length output. And the hash, because it uses a one-way cryptographic algorithm, is almost impossible to reverse engineer. So when we say reverse engineer, that is reverse engineering the algorithm to then change the transaction data, the underlying data of the transaction. You can, though, the whole point of hashing is so you can reveal a transaction or a block. So every block and every transaction is assigned what's known as a hash value. It's the hash that represents the block or transaction, and each block in the chain records the hash of the preceding block. Now this is extremely important because this links or connects the blocks in the chain together. So the hash value, it identifies, in terms of blocks, it identifies the data held in each block, and every block's hash value is different. How is it different? Well, the hashing algorithm contains a feature known as being collision-free. The collision-free feature ensures that no two hash values of blocks are the same. So a block should always have the same hash value. If it doesn't, there's been some changes to a transaction, and this will be reflected in the hash value. So this leads back to the block containing the hash value of the preceding block or the parent block. You compare the hash value that's recorded in the block from the preceding block with the hash value of the preceding block. If they're different, the preceding block or the parent's block's data has been altered, and that will show up because they'll be in inconsistent hash values. So this is what links the blocks in the chain together, and essentially creates an audit trail so people can verify whether the transactions are consistent across the blockchain. Let's now turn to consensus mechanisms. So you have a transaction, it hasn't been validated until you reach consensus. Consensus is essentially reaching an agreement on the state of the network by the nodes in the network. Once a block reaches its capacity in terms of transactions or its fixed length, once consensus has been validated, it adds the next block to the chain. So there are different types of consensus mechanisms, and different consensus mechanisms have different features. I've listed some of the more predominant features here. By all means, these are not the only features of relevant to consensus mechanisms. So the most pressing feature is security and resilience levels. We describe this in terms of fault tolerance. What's the level of consensus you're prepared to accept to reach validation? For example, when you have decentralized, permissionless blockchains, they tend to have, a certain level of fault tolerance. They don't have 100% fault tolerance. They might have about 65%. Why do you only have 65%? Well, this is to make allowances for if there is malicious activity amongst the nodes or node failure, so the blockchain can keep functioning. You also have things like transaction settlement times. Different consensus mechanisms and different types of blockchains have different transaction settlement times. Now, this is quite important, particularly for financial market infrastructure. Do you want instantaneous settlement to reduce risk in the system, say counterparty risk, or is it okay to have a 10-minute or even a few hours settlement times? These are all considerations. What about transaction costs? Transaction costs can be direct and indirect. We see in particular with proof of work consensus mechanisms. It costs quite a lot, especially with larger blockchains such as Bitcoin, to reach consensus. These are indirect costs, the use of energy to mine. You also have to buy mining equipment. So these costs tend to be passed on as far as transactions fees. So users who want to engage in transaction, buying or selling Bitcoin, they'll be charged upfront fees. These are direct costs. These fees will vary depending on the size of the transaction and the settlement time. We also are starting to see things like energy usage becoming quite an important feature. The mainland China I'm talking about last year, banned the mining involving cryptocurrencies. Why? Well, one of the reasons was because of energy usage. Last week, the state of New York passed a bill in their parliament to put a stay on proof of work crypto mining for new market entrants for 2 years. Why? Because they were worried about energy usage. The bill's based on environmental law. So this is a consideration, particularly moving forward with the Paris Agreement and jurisdictions having to meet their climate change targets. So consensus mechanisms vary depending on the type of blockchains and its functionality. I've provided some examples here. These are, by all means, these are not the only examples. There are more than 20, and no doubt more will be developed in the future. So we have proof of work, I've already discussed. It involves solving a mathematical formula, which involves a random variable known as a nonce. It can take quite a lot of computing power, and as I said, there are environmental concerns with that now. You also have proof of stake. So we see with Ethereum, it currently uses proof of work as its consensus mechanism. It wants to move to a proof of stake mechanism because of the energy and environmental concerns. Proof of stake is exactly that, the stake you have in the network. For cryptocurrencies, it is the stake that the nodes, the computers hold in relation to the holding of the cryptocurrency. So if you have nodes holding, say, 65% of the cryptocurrency reach consensus, that fulfills the consensus mechanism. So proof of work and proof of stake are used, say, for permissionless decentralized system. Proof of stake can also be used for permission system. Another variation is proof of elapsed time, and this is more used in permission system. This is designed so there's not actually a task or activity that needs to be fulfilled. It's merely after a certain amount of time has expired, there's a lottery is held, a node or several nodes are selected at random, and they reach consensus. So that's a brief overview of how cryptography works in the blockchain. So as you can see, there's quite a lot of variation there that allows for different functionality for different blockchains depending on the use case. I want to turn now to the blocks in the chain and how the chain actually functions. And so this is a lot more static, except for the actual data that is contained in the blockchain. You can upload pretty well any data or information, process any transaction on a blockchain. But the actual way it's structured is quite static. So the blocks in the chains are validated and authenticated by the consensus mechanism or protocol. And the blocks in the chain essentially contain two parts, the header and the body. So in the header, it contains metadata, the software version of the blockchain. So the blockchain software is updated periodically to enhance security, or if the functionality is going to be changed. So in the header, in the metadata of the block, it contains the latest software version. It also contains two types of hashes. The first is the root hash. The root hash is the hash which is essentially represents all the transactions that are held in the block. Transactions are held in the block body. The root hash is also used in a mathematical formula to calculate the hash value of the block, which represents the block. So the root hash and the hash value are different. It also contains the parent block hash, the preceding block's hash, and I've already discussed that. And so the block header also contains other information that enables the blockchain to function, such as a timestamp for the block and the transactions, consensus goals, and any other information required to make the blockchain function, particularly in relation to the consensus mechanism. The body, on the other hand, is essentially, this is the digital ledger. It contains all the transaction data. That transaction data is arranged in what we call a Merkle tree structure. You can think of a Merkle tree structure as a network diagram that's arranged in a pyramid shape. So across the base of the pyramid, you have all the transactions. You can have thousands of transactions across the base of the pyramid. Each pair of transactions are hashed together to move one level up in the Merkle tree to form a leaf. So you have a hash. If you decode that, it will reveal the a pair of transactions across the base. This occurs right across the base till we get to the first level. We then hash a pair of hashes on that first level together to form a singular hash to move up to the next level of the Merkle tree structure. That represents a parent leaf. This occurs throughout the Merkle tree until we reach the top of the pyramid, and we have one hash that represents all transactions, and that is the root hash that is recorded in the header. Why do we use this hashing for all the transactions? Well, security, obviously, but the other reason is just to reduce computing power when we're searching for transactions or blocks in the chain. So that's essentially how a blockchain functions and its cryptography. Now I want to just quickly discuss the 4 different types of blockchains. So this is another variation that you have to consider if you want to adopt blockchain as financial market infrastructure. So the one that most people have heard of is the public, decentralized, permissionless blockchain that is used, say, for Bitcoin and Ethereum. So you need no permission to join, and all the nodes are involved in the consensus mechanism. However, you can also have private, centralized blockchains which require permission to join. So not everyone can join them, and they have a lot more control by the entity that controls it. So a private blockchain has one entity that controls the blockchain. You can also have a consortium blockchain, and that is a type of private blockchain, but it differs to the private blockchain because you have several entities that control it. You can also have hybrid blockchains, and so you can have a public blockchain which has private blockchain attributes. So certain functions may require permission. A good example of this is the Ripple blockchain. Its consensus mechanism is only available to a select number of nodes, being the banks that are involved in processing payments. You can also have private blockchains which have public blockchain attributes. So you can think of this as it may require permission to join, but once you join, it essentially functions like a decentralized system. A good example of this is the IBM Food Bank Trust operating in Africa. So if we think about the types of blockchains, we can essentially summarize this as 3 distinguishing features. Access: do you require permission? Is it permissionless? Or do certain features require permission? The level of control, otherwise known as the degree of centralization. Is it a public blockchain? Is it a private blockchain? Or is it hybrid where there's just control over certain features? The cryptography that's being selected for the blockchain, the consensus mechanism. So these are the 3 distinguishing features, and it creates quite a lot of variation between different types of blockchains, and blockchains which appear to be similar can actually still be markedly different. So As you can see, there's just not one generic type of blockchain. They can be customized depending on their use case, and all these elements requires quite a substantial lot of variation. And this leads us back to the financial regulatory cryptogram. So if you're a financial regulator, a financial ministry, a government, and you're considering adopting blockchain technology for financial market infrastructure, there are several fundamental questions that need to address. Obviously, you have to make sure that if you're going to adopt any new system or particularly blockchain technology, that there's going to be some distinct advantages over the status quo. So there's no point adopting it if there's only going to be very minimal advantages provided by the technology. So are the advantages sufficient to justify changing the status quo? And with adopting any new system, particularly for financial market infrastructure or any new technology, there will be certain trade-offs. So what are the financial market weaknesses that are introduced by blockchain technology? So we can think about this when we're talking about financial market infrastructure as risk management, because financial markets, risk management. So what risk will be introduced? Because we're introducing new technology, there will be technology-based risks, cybersecurity risks, and also data protection risks. How will the technology conform with data protection legislation? Are there any design flaws that will be introduced by the technology? Now, what we see, particularly with decentralized permissionless blockchains, one of the advantages that is regularly touted is that it is immutable. Purportedly, it's impossible to change the data once it's been uploaded and validated on the chain. But is this really what you want with financial market infrastructure? Obviously, you don't want financial market participants to be able to change the data once they've uploaded and validated that data. But do you really want, as a financial market regulator, to be in a position where you cannot change the data? If you take a realist approach to this, there will be certain financial market participants that will be involved in illicit behaviour, money laundering, counter-financing of terrorism, or other criminal behaviour. And they will upload data that is inaccurate or outright fraudulent. Do you want to be in a position where you cannot change, if you discover this, you cannot make amendments to the blockchain? Or even situations where you have credible, honest financial market participants and they just mistakenly upload inaccurate data? What about market inefficiencies? I talked about earlier about the ASX chess replacement blockchain not being able to handle large daily transaction volumes, trading volumes. Similar for other blockchains is large spikes in transactions or daily trading volumes. Are there liquidity risks introduced? Particularly with financial market infrastructure, this is extremely important. You want to always maintain liquidity in the system. This was a problem during the global financial crisis, particularly with interbank lending markets, wholesale lending. How will the technology influence financial market participants' behaviour? If you use a decentralized permissionless system, will that make it difficult to identify people? Will that create a loophole that might in fact promote illicit behaviour? Or will you be in a situation where you can collect and analyse more data than what you can now with the status quo, where you can mitigate illicit behaviour? All quite relevant considerations. Now, from the perspective of actually regulating the blockchain, are existing financial regulatory frameworks fit for the purpose? If not, what amendments do you need to make? Or if we look to other technologies, such as crypto assets, we found that this has been very challenging for financial market regulators. They first attempted to regulate crypto assets based on securities regulation. Problem was, not all crypto assets are defined as a security, so they fall outside the regulatory parameter. Similarly, for blockchain being used as financial market infrastructure, will we need new regulatory frameworks for certain markets? And then from another perspective, there's no point designing the optimum blockchain for financial market infrastructure from a economic and market perspective, just to find that when we look at how it will comply with the financial regulatory framework, that it creates loopholes or certain undesirable outcomes in terms of regulatory compliance. We have to be aware that the financial regulatory framework will also shape the design, and it may be quite markedly different to the most efficient economic design. If there are in fact regulatory gaps in the system or inefficiencies, can we use other technology to overcome these shortfalls? Say for financial market participants, can we use technology to enhance their compliance capabilities, such as regulatory technology or RegTech? Alternatively, can the financial regulators use technology to enhance their supervision? So what I'm thinking about here is, say, particularly with data analytics, when we look at particularly the use of the application of blockchain for financial market infrastructure, we're talking about extremely large daily trading volumes and large spikes in trading. This will typically be beyond human capacity and the resources of financial market regulators. Can we use things like automation, artificial intelligence, machine learning to do all the grunt work, to be the first line the first line to address these high volumes of transactions, and then to identify suspect transactions which can be passed on to humans to make a decision? All of this will all have to be taken into consideration when financial regulators, financial ministries or governments are considering adopting blockchain as financial market infrastructure. We also have to consider the viability of the blockchain. So is it a viable alternative? And then if it is viable, because financial markets are different, because financial systems are different, because financial regulatory systems are different for each jurisdiction, each application will need to be tailor-made, customized for that particular application. From a technological standpoint, from a financial and legal regulatory standpoint, from an economic standpoint. But we also have to make a business case. Again, turning to the ASX CHESS replacement, it's taken 6 years. It will take 7 years. The ASX is a for-profit entity. It's listed on its own stock exchange. The cost in developing its CHESS replacement will have to be passed on to market participants. Will those costs will those costs deter certain market participants from using the technology? Or will the cost to develop or maintain the technology be cost prohibitive? So we need to make a business case for adopting the blockchain. We need to satisfy certain cost benefit analyses for obviously the development, the maintenance, and the cost that will be passed on to users. So what we do know. So tonight, from what I've explained with the variability in the design, the different types of blockchains, and just with the questions that need to be addressed, that you should see by now that adopting blockchain as financial market infrastructure from a financial regulatory perspective is not merely an application of the law to determine viability. it requires a holistic approach. And this is essentially the financial regulatory cryptogram. We need to take into account technological designs for how it's going to function. We need to take into consideration economic and financial considerations, particularly behavioural economics, liquidity, capital requirements, things like that. We also need to take into consideration financial regulation and legal systems. So what we do know is that the design and the regulation of blockchain for financial market infrastructure is an intersection between technology, finance, and regulation. And what we do know that financial market infrastructure is being redesigned. And that's the realist approach again that I'm talking about. In most cases, financial regulatory frameworks will need to be redesigned. So my research for the foundation moving forward. My research will focus on the regulation of financial markets and the regulation of blockchain technology being used as financial market infrastructure from a technological, financial and legal perspective. So I'll be taking interdisciplinary comparative analysis to determine viable use cases, but I'll also be taking a very critical approach to this where I'll be identifying unviable blockchain designs and unviable design features of certain blockchains in certain jurisdictions. So this will, from a financial regulatory perspective, this will involve appraising the parameters and the limitations of current financial regulatory frameworks. And this will be done depending on the application domestically. You can think of this, let's say, for most stock exchanges, they operate in a domestic capacity, but also cross-border applications. So you see this obviously in trade finance, but in particular, the use for central bank digital currencies from a wholesale perspective. So we need to look at what happens if there is a dispute involving a transaction that has occurred cross-border, say involving two interoperable blockchains. How will that be resolved? And so in looking at this, I'll propose regulatory amendments and or whether new regulatory frameworks will be required to ensure that there is sufficient compliance. And what is the role of other technologies to fulfill financial market participants' compliance obligations and to ensure that there's suitable compliance from the regulator's perspective? Is there a role for RegTech and SuperTech in the mix?